Covenants in lending business. Covenants are conditions or restrictions imposed by lenders to ensure that borrowers maintain financial discipline and reduce credit risk. These are included in loan agreements to protect the lender's interest and ensure the borrower's ability to repay the loan. Types of covenants in lending. 1. Financial covenants. These require the borrower to maintain specific financial metrics. Common financial covenants include debt service coverage ratio, DSCR covenant. Example, DSCR must not fall below 1.25x. Ensures the borrower generates enough cash flow to cover debt obligations. Leverage ratio covenant, debt to equity ratio. Example, debt to equity ratio must not exceed 3.0x, limits excessive debt financing. Interest coverage ratio covenant. Example, EBITDA to interest expense must be at least 2.5x, ensures the borrower can meet interest obligations. Current ratio covenant. Example, current ratio must remain above 1.2x, ensures the borrower maintains liquidity for short-term obligations. Minimum net worth covenant. Example, borrower must maintain a net worth of at least $50 million, protects the lender against excessive financial deterioration. 2. Affirmative covenants. These require the borrower to perform certain actions to maintain good financial health. Examples include timely financial reporting. Borrower must provide audited financial statements quarterly or annually. Insurance maintenance. Borrower must maintain adequate insurance coverage for assets. Compliance with laws and regulations. Borrower must comply with all legal and regulatory requirements. Use of loan proceeds. Borrower must use the loan only for approved purposes, e.g., business expansion, working capital. 3. Negative covenants. These restrict the borrower from engaging in certain activities that could increase financial risk. Examples include limitation on additional debt. Borrower cannot take on additional debt beyond a certain level without lender approval. Dividend restrictions. Borrower cannot pay excessive dividends or distribute profits beyond a set limit. Restrictions on asset sales. Borrower cannot sell major assets without lender consent. Merger and acquisition restrictions. Borrower cannot merge with or acquire another company without approval. Capital expenditure limits. Borrower must not exceed a specified cap on capital expenditures. 4. Performance-based covenants, cash flow triggers. Some lenders include performance-based triggers where certain financial conditions must be met. Step-up interest rate clauses. If DSCR falls below a certain threshold, the loan interest rate increases. Accelerated repayment clause. If cash flow deteriorates, additional loan repayments are required. Covenant violation and consequences. If a borrower breaches a covenant, the lender may 1. Issue a waiver, allow a temporary breach if justified. 2. Impose penalties, increase interest rates or restrict financial activities. 3. Demand immediate repayment in case of severe violations. 4. Enforce collateral seizure if the loan is secured. Would you like